Hello, this is Charting Man Dan of TheChartGuys, where we teach the little guy and girl how to utilize charts to manage their own trades and investments. What do I mean by the little guy and girl? Well, we just had two directives signed halting the implementation of a rule that requires financial advisors to act in the best interests of their client. Let that sink in a little bit. The big wigs on Wall Street can play with your retirement and hard-earned money without your best interests at heart. We currently have hundreds of members taking charge of their financial future, and we would love for you to come check out a free week with no credit card required to see if our services would be beneficial on your path to financial independence as well. What we offer, we have a separate course of over 5 hours in length on when to enter and exit positions. And in terms of what we do daily, we have nightly videos, key levels updated each morning before the bell, 2.5 hours of live daily webcam coverage in the morning and in the afternoon, and over 7 hours of educational videos. All of these links can be found in the description of this video. Come check us out. Thanks for watching. Let's get on to the technical analysis. Hello everyone, market rundown heading into Tuesday, April 11th. So the S&P 500 saw a bullish start to the day, and then the bears crept in towards the early afternoon. And we rejected from this middle Bollinger Band resistance for the third time in a row. That level is 235.45, but what is more worth our attention, in my opinion, than that middle Bollinger Band is this downtrend resistance line, which has given another, and that is the wrong one. I was wondering why that looked odd. Here we go. It is giving another rejection right off of the high of the day with our lower high pattern on this daily time frame. So the bulls have to prove that they have the strength to get over that downtrend resistance line, and as of right now, they don't have that strength. So really, we have a converging tightening range here between the 50-day moving average support, which held the last support test, and this clear downtrend resistance line, which rejected the high of last week and rejected the high of today. And so we're going to see a make or break here as we see, 3 more trading days in this shortened week. It's going to be very tight by the end of this week, and I would anticipate we see a break in the near-term future. The weekly time frame sees this tightening range. We've got the exponential moving averages continuing to hold. Bearish MACD cross is seeing some follow through. Unless the bulls can show up and save the week and see a strong bull break, we are going to see that bearish MACD cross, which has not happened since the election. So we're watching these exponential supports, which also have been supports since the election, and we'll be keeping an eye out for a loss of those levels. 234.59 is the 8-period exponential, and we're not too far above that level currently. So watching very close for some potential bearish action. IWM, big upper wick of profit taking off of the 50-day moving average resistance and closing down much closer towards the low of the day than towards the high, giving that bear momentum into tomorrow. So we have our lower highs here, 138.33, 138.17, and 136.85, keeping that lower high pattern intact. But we do still have a higher low pattern on the daily as well, looking at 135.16, 134.75, and then on down to 133.83 as a couple key support levels to be watching. So it's a tightening range where we have these higher lows and clear lower highs. So same thing as SPY, just a different setup. A break is imminent here on IWM. And the weekly time frame, we can see that we've gone back and forth with this middle Bollinger Band. So going back and forth means I'll put less weight into that moving average rather than the S&P 500 and its exponential moving averages, which have held so consistently. And we are on the verge of this bearish TCG cross. The bearish MACD cross already happened over a couple months ago. And this bearish MACD cross, or I should say this bearish TCG cross of the 4-period exponential over the 8-period to the downside is getting a bit of momentum. And if we head back down and see a break of this key support of 132.40, that will be a clear longer-term break. And you can see these Bollinger Bands on the weekly time frame are indicating how tight this range is currently getting. So other people might argue this is a potential bearish reversal head and shoulders pattern with the left shoulder, the head, and the right shoulder. Certainly doesn't look textbook, but the neckline support is the main factor to be watching, and that is definitely relevant down in the mid-132s. QQQ, indecision 3 days in a row, similar to SPY, with upper wick and lower wick the same size, open and close the same place. Middle Bollinger Band support holding, but I'm looking at the low of this pullback from last week, and that's down at 131.50. Break 131.50, and we're looking down at 130.55 and the must-hold level of 129.40. So the tech sector is seeing a little bit more weakness than we've seen recently because it's been so strong, and that's leading to a little bit more QQQ weakness than we've seen. But the all-time high is right here, 133.48, so a bull break on the S&P 500, and we will be right there at all-time highs for QQQ. So not seeing that bearish weakness yet, Bearish reversal candlestick last week, not confirming it yet at this point. We would have to lose 131.76 support and see further pullback below daily exponential moving average supports to confirm that bearish reversal candlestick, and be keeping an eye out for a bearish MACD cross here as well. So basically where we stand in these markets is we've got tightening ranges with higher lows and lower highs. A break is imminent, likely by the end of this week, and if not, certainly early next week, and that's going to dictate where we're looking for the next couple of weeks in terms of direction. So we'll be paying close attention. We'll keep checking back in. We'll see you tomorrow.